Good afternoon, matriculants, and welcome to the first session of Microeconomics for grade 12s. The topic we're going to be discussing today is perfect markets. So let's get started. Right, we're doing grade 12, Microeconomics perfect market. I hope you have enjoyed doing the exercises that has been set for you. Right, we're first going to have a look at some background information. We're going to look at the theory before we get into the actual exercises that you've been working on. Right, so when it comes to perfect competition, the definition of a perfect market or perfect competition, it is a market structure with a large number of participants selling products that are homogeneous. And now some of you will probably say, what is the meaning of this word homogeneous? Homogeneous means that they are all the same, right? The products are similar in every respect with regards to the physicality of the product. Prices are set by the market forces, and the market forces is demand and supply. The characteristics of a perfect market. Number one states that there is a large number of buyers and sellers. Now, let's say you asked to explain this point for 4 marks. So a large number of buyers and sellers, and how would you explain that or express that? You would then, from that you can see, because there are a large number of buyers and a large number of sellers, that tells us that there is lots of competition within this type of market, right? Because there are many sellers selling exactly the same product. Number 2, the buyers and sellers act independently, meaning they are not concerned with what the other one is doing. They work on their own. They are independent. Number 3, the sellers are price takers. And this is a concept we're going to look at in a bit more detail later on. But what that means is when we say they are price takers, meaning the seller does not set the price for the product, right? The prices, as we saw in the introduction, is set by demand and supply. Number 4, entry and exit is completely free, meaning anybody can enter or leave the market at any time or for any reason. Number 5, products are identical. There are no trademarks here, right? Meaning the products are all exactly the same as I said earlier on. Number 6, buyers and sellers have full knowledge. So what do we mean when we say the buyer and seller has full knowledge? It means that both the buyers and the sellers are fully aware of what the current prevailing market conditions are. So they know what the price of the product is, they know where to get to access the product, so they have full knowledge of everything. Number 7, businesses strive to achieve maximum profit. As you know, this is the aim of any business, right? They want to make maximum profit. And then number 8, examples of perfect competitive markets is your Johannesburg Securities Exchange, or JSE, where they sell shares, right? And the last characteristic, the demand curve is horizontal, right? Another term you can use is, because as you know, when the demand curve is horizontal, this is also known as a perfectly elastic demand curve, right? A perfectly elastic demand curve, or the demand curve is horizontal. Right, then the next very popular 8-mark question discussed what is the difference between your short term and your long term when we look at the production capacity of a business. Now I just have to iterate here and to just caution those of you who do accounting, when we talk about short-term and long-term in economics, we're not referring to the amount of months here, okay? We're looking at, in terms of production capacity, we're looking at short-term and long-term. So now we're just going to look at what's the differences between the two. So in the short term, we have an additional variable production factors such as labor or capital are employed, right? So what we're saying that in the short term is normally the time when you have one factor of production that will become a variable, and that is merely to just increase your production capacity quickly. And then in the long term, additional technology can be implemented. Now, what we mean by additional technology, let's say, for example, you need a new machine or you need to upgrade your current machinery in order to increase your production capacity. So that is what we're saying. And this happens over a long term. So which means you can plan for that, because these are very expensive. If you think of buying a new machine, it's a very expensive item and you need to plan for those kinds of expenses. You can't just at the drop of the hat go and spend 500,000 Rand for a machine. So therefore, in the short term, what we find is that there is one variable, whereas in the long term, everything becomes a variable. Right, in the short term, overtime is implemented. Now, as you know, the term overtime, meaning that workers work above their normal time, right? As you know, Basic Conditions of Employment Act states that workers have to work a 40 to 45-hour week, so any hours over that or extra hours worked is known as overtime. So let's say, for example, you are used to producing 1,000 units a week, and all of a sudden you now get an order and you need to, for next week, produce 1,500 units. No businessman is going to say, sorry, I'm at capacity, I can't take this on. Remember, they want to make maximum profit. So whenever they can get anything extra, so what they will do is they will then ask their workers to rather work longer hours, right? So they would get them to work overtime in order for them to be able to meet the capacity of 1,500 as opposed to their normal 1,000 units a week. In the long term, business can increase or they can build a new plant, right? They can either increase or they can build a new plant. So what we mean by increase, meaning they can look at what the existing space that they have and they could just add on, or they need to maybe buy an entirely new space, right? So those are the options that are available to them. So in the short term, we find that a shift system is implemented. Remember, we said workers are working overtime, so now you get people coming in the morning shift and an afternoon shift, etc. Or new businesses, in the long term, new businesses can enter the market. In the short term, we find that economic profit is attainable in the short term, and in the long term, only normal profit can be attained, right? So, very important also to remember is businesses will produce at the lowest possible average cost. Right, so together with your perfect market comes our South African competition policy, right? And the aim behind the South African competition policy was to prohibit the abuse of power. That was one of the things they wanted to achieve, but at the same time, they also wanted to encourage more competition within the market. So, the South African competitions policy is made up of, first of all, you get your competition commission, right? And the job of the competition commission, or the function of the competition commission, is to investigate and make recommendations. So they've got to investigate where they or somebody might have complained to them and said that there's something going on here between these businesses, you need to look into the matters. So they will either investigate based on the complaints that they get and then make recommendations, or if any of them on their own realize that something is not right. And then once they've investigated and they found that there are things happening that shouldn't be, they would then take it to the competition tribunal, right? And it is then up to the tribunal to either accept or reject the recommendations made by the Competition Commission. And it is also the job of the competition tribunal to give out any sentencing. For example, the most of the time when you see companies have been brought to the Competition Commission, there's normally a fine that is payable, right? And here you can think of your everyday examples of companies that have been brought before the Commission, either as a result of collusion or whatever they've done. So your examples there are companies, the cell phone service providers, they've been fined and charged and on occasion. There was Tiger Foods that had been charged. And then there was also the construction companies. They found that 5, I can't remember the names of those 5 companies, but there were 5 of the huge construction companies in Cape Town that was fined for collusion with regards to the building of the Cape Town Stadium. And that only came to light a couple of years after the World Cup. So then if these companies are not happy with the fines that have been issued by the competition tribunal, they can then go to the competition appeal court and they can go and appeal with them regarding the fine or whatever sentencing they had been given. And the competition's appeal court has the same standing as the High Court. Right? And this is one of the arguments that consumers have with regards to the Competition Commission, in that they feel that the fines that are set are not always enough to be a deterrent, because they say the amount of the fine is normally a very small amount compared to the profits they've already earned from whatever business practices they are being found guilty of. Right, and then question 1. You were asked to answer the following questions. Name any 2 examples of fixed costs. What I like about this question is that whenever you speak to learners about fixed costs, the only one they ever remember is rent, because it's irrespective of how many units you produce, you still have to pay the same amount of rent. Your rent is not dependent on the amount of units you produce, so therefore that's a fixed cost. And that seems to be the only one they know of, right? So there are other examples as well. For example, a business has to take out insurance, right? Insurance on its vehicles, insurance on the machinery, but there is and public liability insurance and all of those kinds of insurances they take out. And it doesn't matter, the insurance companies are going to come and ask you, oh shame, you haven't produced anything this month, so we're not going to charge you. No, you have to pay your insurance policy every month, because if you don't pay your policy, you can't get the claim. So that's another example of a fixed cost, is insurance. So your fixed costs are all of those costs that you have to pay, irrespective of the number of units that are produced, right? So the 2 that I can give to you now is rent and insurance, and I'm not sure if any of you have any other examples that you might have listed as one of your answers, right? Those are not the only 2. A little later on, we will take a look at the full answer, okay? Number 1.1.2 asks, how can a lack of information cause an entrepreneur to make the wrong decisions? How can a lack of information? So we need to first understand what is this question asking, okay? So the crux of the question is about having lack of information. So how can a lack of information cause an entrepreneur to make wrong decisions. Okay, so meaning he doesn't have enough information, and because as a result of not having enough or the correct information, that can lead to someone making the incorrect choice, right? Or making the wrong decision. So when it comes to a question with a how, right? This is the only answer, and there's no other answer that can be given. Okay, Matrix, you've got to think, what are the things, if you think logically about it, how is it that if an entrepreneur doesn't have the correct information at hand, how can this lead to a wrong decision being made? Now just think about it. If you didn't know which sections is going to be tested, let's say you're writing a class test, and the teacher didn't give you any information as to which chapters are going to be tested, and you just decide I'm going to study chapter 2 and 3, and you get into the test and it's chapter 4 that is being tested. So you need to have the correct information to do what is necessary. Okay, so therefore the entrepreneur needs to have all the information on hand in order to make the correct decisions, right? So, what kind of errors can an entrepreneur make if he doesn't have all the information at hand? Number one, let's say, for example, he is somebody who is producing a certain line of products. Let's say they're making handbags, ladies' shoes, and men's shoes. But the entrepreneur is not aware of the fact that the handbags are not selling as well as they should. So it would be in his best interest to rather leave the handbags and concentrate on the ladies and the men's shoes, because those are the lines that are selling very well. But now if he didn't know that, and then he decides, oh, my business isn't making so much money, I'm going to stop producing men's shoes, then he's making the incorrect choice, because he should have let go of the bags instead, because the men's shoes were selling better than the handbags. So do you understand that if he makes an incorrect choice, it could lead to what we call production inefficiency, right? It's some kind of inefficiency can develop from that, right? And remember, the two kinds of inefficiencies that we work with in economics is your allocative inefficiency and your productive inefficiency. Question 1.2, study the graph below and answer the questions that follow. So the graph that I'm looking at is the graph referring to the shutdown point. Now, please, matriculants, I cannot stress this point enough. When we talk about the shutdown point, this does not necessarily mean that the business now shuts down, that the business closes and it stops operating. That's not what it means. Shutdown point is the example I used earlier on about the handbags, the shoes, ladies and men's shoes, is when they're producing a certain line and one line isn't selling and it's not profitable for the business to be selling that line, then that has to be shut down, right? Where they close a portion of the business. Alternatively, a business could decide to, because they're not making enough profit, they might want to save on costs, because remember, in order to get to my profit, it is the difference between my revenue and my cost. So the only thing, remember, your price in a perfect market is set. So you can't decide, oh, I'm going to now sell for much more in order to make more money. No, you've got to try and sell more products in order to make more money. But it is not just about selling extra products if it's going to cost you more money to make those extra units. So the only other thing you can sort of play around with is your cost. That is something the business has full control over, what their costs are. So what some business will do, and I'm sure most of you have heard this term already used by your parents or people you know, they talk about, oh, we're on short time, and especially during COVID-19, you heard, I still know of people who are still on short time as a result of COVID-19. So What that means is they reduce the number of hours that their workers have to work, which means they don't have to pay them as much at the end. So it's when you come to the shutdown point, this is the time the business has to take certain steps and make certain decisions. And those of you who do business studies, remember you did all those strategies that businesses do, those defensive strategies, etc. That is the kind of thing that we're referring to with the shutdown point. So let's look at the questions that have been asked. 1.2.1 asks, identify the market price in the graph above, right? So in other words, the market price, meaning the price that is being charged, right? What is the market price in the graph above? So if you look here, this here refers to your revenue and costs. So that's where we're looking at, okay? So we need to see how much is being charged for the product here, and the market price here is 20 Rand, okay? 20 Rand is that one there, 30 Rand is what is being charged there, right? 30 Rand, because there you go, and there we see it goes down to the 200. That's been highlighted or bold. So 30 Rand there. At what point does MC intersect AC? So there's my MC curve, and here's my AC curve. So the point that they're referring to is point B. Briefly describe the term break-even point. Okay, so the term break-even point is a point where your costs are equal to the revenue, right? So that point where your average cost equals your average revenue will be known as the break-even point. What happens at point D? Right, point D is where my AVC and my MC meets. So I know where MC equals AVC, that point is called your shutdown point. Explain what would happen if the market price increases to 50 Rand. So it's 30 Rand. So what's going to happen if that price increases to 50 Rand, right? The market price increases to 50 Rand, meaning you've got to now sell at 50 Rand. So if you see at 30 Rand, we note that our cost is above the revenue, meaning my cost is more than what I'm earning. So if I'm spending more than what I'm earning, I'm making a loss. But if the price had gone up to 50 Rand, then my costs will be below the amount of money that I'm earning. So then I will be making a profit, right? So then this business will be making an economic profit. Right, 1.3. Okay, before I just rush off to the next question, are there any questions, matriculants, with any of these that we've already done? Do any of you have a question? Can we carry on then? Right. So let's just go and have a look. We'll have a look at the answers. Remember, I said to you earlier on, we will look at the answers in more detail. So the two examples of fixed costs, we spoke about insurance and rent, but there's also depreciation as well as salaries as well, okay? And as the memo says here, accept any other correct relevant response. We spoke about the inefficiency that can occur. And we don't have the answers for 1.2 here. Okay, right. So we're on to 1.3 now, and we're going to look at the questions for 1.3. Right, 1.3, they say identify the quantity the firm will produce at equilibrium point. Now that is, it tells you there's the small e, that is my equilibrium point, and the quantity at that point, so I go from equilibrium point, I move down to my quantity, and I see there that at that point it is 180 units that's being produced. So the answer there will be 180. Which curve represents the market price for the perfect competitor? Right? Your market price, which is that price there. So what curve is that? That is what we call our average revenue curve, or the DD curve, right? Briefly describe the term normal profit. So please note, I'm looking at the mark allocation. If it's only one mark, I only need to give, like there, the answer will be the number 180. Which curve, there will be AR or DD. But when it says 2 marks, then I know my answer must be in a sentence. So it says briefly describe the term normal profit. So normal profit is earned, normal profit is also known as your break-even point, and normal profit occurs when your marginal cost is equal to your marginal revenue. Okay. So why do we refer to this as normal profit? Let's just look at that concept very quickly. So with economics, we take into account our implicit as well as our explicit costs, okay? So therefore, in business, they call it the break-even point where cost equals revenue, because in business and accounting, they only look at the explicit costs, right? They don't take into account the implicit costs. So what's the difference between explicit and implicit? Explicit means all the expenses that the business has, the actual expenses, whereas implicit, we take into account the money that could have been earned if you had taken the money and invested it elsewhere, right? So we look at what we call the difference between accounting profit and economic profit. So your economic profit takes into account the implicit costs as well. So therefore, let's say, for example, I inherited some money and I start a car wash, but I could have also taken this money and just put it into a savings account where I would have earned interest on that money. But by starting a car wash, I am earning a salary out of the car wash, and the salary I'm receiving from the car wash is still more than the salary that I'm getting from the interest that I would have been earning from the bank. So that's the difference between your economic profit and your accounting profit, right? So your economic profit looks at what else could I have invested my money in. So with perfect markets, this is the point where you want to be, because what this is telling me is that with normal profit, as the entrepreneur or the owner of this business, the amount of money I'm earning out of this business is more than what I would have been earning had I invested my money elsewhere. Okay, so that is why that is the point where you'd want to be to remain in the market. What would the impact on the market be if many firms leave this industry? So what's going to happen is, if many firms leave the industry, then that means that the supply is going to decrease. And after we do the next question, I will come back to that one again, okay? Then it says here, redraw the above graph and insert the average variable cost to clearly indicate the shutdown point. So all you had to do was to copy this graph as it is, and then the only difference between this and the 1.3.5 is you would now draw another curve below this, and you would call that your AVC, and you will draw in your new revenue line as well. Let's have a look and see what that would look like. Okay, can you see there? That's the original drawing there, and then we've now just inserted the AVC curve and then drawn the new average revenue, marginal revenue demand curve, and or the new price, and then that would then be the shutdown point. Now remember, what we're saying here is the price is decreased from 200 to 150, which I will also explain a bit later on now. Okay. Right, because 1.4 asks, discuss price formation of an individual firm under perfect competition with the aid of a well-labeled graph. Now, when you're talking about price formation in the perfect market, remember, what did we say? The price is set by demand and supply. So therefore, you draw the industry graph or the market graph, and then alongside this, you have to draw the individual business or the individual producer. You cannot draw these two graphs one below the other, right? They have to be drawn alongside one another. So where the demand and supply curve meets, here, it's P1, and then that is the point that is then carried over to the individual business. And because they're a price taker, they have a horizontal marginal average revenue curve. Okay. So this is in explaining the price setting. Now, just to quickly illustrate to you that other point that I said I'm going to come back to. So if you look at the graph for the industry or the market, so we've got supply, and we've got demand. And we said where demand and supply meets, that is where the price will be formed. Now, if we just go back up to that other question very quickly, 1.3.4, what would the impact be on the market if many firms leave this industry? So when firms leave the industry, it means your supply is going to decrease. So therefore, your supply curve will be displaced to the left, right? So what do we notice is that here we have the original price, right? That is where the original equilibrium was. So when the supply decreases, we're going to find a new equilibrium point at E1. So what do we notice? The price then increases from P to P1, right? So that's what the effect will be if many firms were to leave the industry. We will find that the supply decreases, and as a result of the supply decreasing, that forces the price to go up, which means then the price that the individual business charge will also go up, right? There it says the supply curve in the market will shift to the left or decrease in the supply, and then the market price will increase. Okay, so if you didn't understand it in words like that, here it is now in a picture for you, right? The supply decreases, and as a result of that decrease in supply, the price has increased. Then also to explain the point here, that drop in price. What will cause that drop in price? So as supply increased, we see the price went up. But if the supply curve moves to the right, meaning your supply increases, if there's a shift to the right, what do we notice now? Now we see a new equilibrium is formed and the price decreases now. So let's call that P2, right? So what's happening here is new businesses had entered the market, so therefore there was a drop in the marginal revenue, average revenue, or in the price that the business could charge, and therefore now they sit in a position where their average cost is way above their average revenue, right? And therefore we have a shutdown point because the only thing this business can pay for is for its variable costs. It cannot cover the fixed costs. Okay, and therefore shutdown is then, or they've got to now decide what they're going to do in order to fix that situation. Okay, right, so the question here says, discuss price formation with the aid of a well-labeled graph. So for 8 marks, you're going to receive 4 marks for the drawing of the graph here. Okay, so the way in which the marks are allocated, the interaction of supply and demand, which is that point there, and you've got to actually show that point there, so that will give you a mark. The link between the price, so to show how you've now carried that over to that side, that will be another mark. The correct drawing of that curve will be another mark, and then the labeling of the curve. And please remember, it is DD, these are the Afrikaans labels. It should be DD, average revenue, and marginal revenue. Now, if you cannot remember what that is, I would tell you, remember the following. If you remember Mr. Darp, right? Mr. Darp, that means it is my MR curve, my demand curve, my average revenue, and my price. So you can't forget the labeling of this curve then. Right, now that is the 4 marks. The other 4 marks will be given for the discussion. And your discussion is simply explaining what is happening on the graph. So here it says the market forces of demand and supply determines the price OP1. We see there, right, OP1. And the sellers are too insignificant to influence the market price, hence they are price takers. Each individual producer is forced to sell his goods at the market price, which is OP1 on his graph as well. And that's all you need to say there. Right, the next question talks about, with the aid of a well-labeled graph, explain economic loss in a perfect market. Once again, we're talking about the drawing of a graph and explanation. Always maximum 4 marks for the graph, which means your discussion would also then be 4 marks. Right, so when you look at an economic loss, so we know that you make a loss, as I said to you earlier, when your cost is greater than your revenue. So therefore, this AC curve must be drawn above the AR curve, right? Now, I have to stress this. Please, they will produce at point E, or where MC and MR meet. That is your profit maximization point in a perfect market. So therefore, that is the point at which they will produce. So I draw my quantity line, and then from that point, I draw the line up to the AC curve and across so that I can get the portion of my loss, right? So to discuss this, your total revenue would be P1EQ10, right? And your total cost would be CBQ10. So we can see from that, it is total revenue minus total cost to get your profit, and you can see the revenue is much smaller than the cost, because if we must use the numbers, it's going to be 40 times 10, which is 400, minus 50 times 10, which is 500, and 400 minus 500 is going to give me an answer of minus 100. So if it's a negative answer, then I know I'm making a loss. And on the graph, this loss is represented by C, B, E, D. That area represents the loss. And that's exactly how you can explain but you only need these 2 points to get your other 4 marks. Okay, so that's exactly how you would then explain that answer. Right, we're moving on. And are there any questions at this time? Still no questions coming through? Okay, so we will then move on to question 2. And it says, name any 2 institutions that regulate unfair competition in South Africa. Now, if you remember earlier on, we just spoke about the competitions policy, and the 3 institutions involved with that was the Competition Commission, Competition Tribunal, and the Competition Appeals Court. Now, any 2 of these 3 would be correct. Why is a perfect competitor unable to influence the market price? Once again, a why question. Remember earlier on we had a how question. So just the way you see it and how you want to explain it, okay? And what did we say? There are many sellers in this market, so they do not have any power. They cannot influence the price, and they are completely independent of one another. Right, question 2.2 is once again a data response question where you were given these 2 graphs and then you had some questions based on the graphs, right? Once again, there's our industry graph and our individual firm. Right, let's look at the questions asked. 2.2.1 says, identify the equilibrium point of an individual firm above, right? So we want to know what is the equilibrium point in the individual business. So here's the graph for the individual business, and we must now go and see what is the equilibrium point. Now, the only 2 points we see is point A and point B. So now it is important to remember that market equilibrium is where demand and supply meets. And at this point, you should already know that there's your demand curve, that horizontal line there, and this portion of your MC curve makes up your supply, right? So where your supply and your demand curve meets, that's where equilibrium will be. And in this example here, we see there's demand, there's supply, so it's going to be at point A. Question 2.2.1, which time period is depicted in the graph above? And if I remember from the characteristics that we did, it said that economic profit is made in the short run. And this year is representing economic profit because there's my revenue line, right? Which will be 10 times 20, which is equal to 200. There's my cost coming here below the revenue, which is going to be 8 times 20 is 160. So it's 200 minus 160, which gives me a profit of 40. And we said earlier on that your perfect competitor only makes economic profit only in the short run. Because as we saw from the graph that I just drew, that economic profit acts as a magnet for other suppliers to enter the market, causing then that 10 Rand to maybe drop to 8 Rand. So then in the long run, they're only going to make normal profit. What is the reason for the downward sloping the downward sloping demand curve of the industry, right? If you just look at the drawing that I've drawn here, you see there's the industry's demand curve and it's downward sloping. So here we can clearly see the law of demand being practiced, where at higher prices, less is being demanded, okay? The reason for that is obviously there's the substitution effect, income effect, etc. Why are business in this industry referred to as price takers? As we said earlier, the business has to accept the price that is being set by demand and supply. How will new entrants or businesses affect the perfect market? I think we've already seen this in this drawing that I've got in front of me once again. We said if new suppliers enter, supply is going to increase from S to S2. So there's going to be an increase in the number of suppliers, which is then going to cause a new point of equilibrium, which means the price is going to decrease. So new entrants will affect the perfect market by shifting the industry supply to the right, leading to an increase in quantity supplied, and the price will drop, right? Applying a lower price from the industry and produce at the lowest turning point of the long-term average cost curve. Right, 2.3, another data response where we're looking at the economic loss, and this is when your average cost is once again bigger than your average revenue. Right, identify the market structure. Just by looking at that horizontal line going through there, I know that this is a perfect market. Give the value of the market price depicted above. So that would also be my price line. Remember Mr. Darp, right? The P for price. So that is 50 Rand, right? Does it say Rand? Yes, it says Rand there in brackets, so my answer is 50 Rand. How will this equilibrium position change in the long run? We just said that in the long run, all of them make normal profit. So how will this lead to normal profit? Obviously, there are some businesses who are unable to sustain this loss and they will leave the market, so thereby decreasing the number of suppliers again. So the supply curve is shifted to the left, causing the price to increase once again. Okay. And then some businesses will make normal profit. What conditions must exist for this firm to shut down? Remember, making a loss doesn't mean shutting down immediately, because that can still be turned around. But in order to shut down, your AVC must be equal to your MC, and that's not indicated on this graph. Okay. Right, they ask you to calculate the economic loss faced by this firm. So let's go up to our market to get our numbers now. So to calculate profit or loss, it is total revenue minus total cost. Two ways in which you can do this. You can just say 50 Rand, which is your average cost, average revenue, minus your average cost of 90 Rand is going to give you an answer of negative 40. But that's average. You need to get to total. So then you take your 40 times 100, which will then give you an answer of a negative 4,000. So your loss here is 4,000 Rand. Another way in which you can do the calculation, total revenue, it's 50 times 100, which is 5,000. And your total cost would be 90 times 100, which is 9,000. So you got 5,000 minus 9,000 is going to give you a negative 4,000. So therefore, same answer, different calculations. Just have a look at that answer quickly. You see there, 50 minus 90, negative 40, times 100, negative 4,000. And that will be worth 4 marks. Or alternatively, you can say 50 times 100 is 5,000, minus your 90 times 100 is 9,000. You're still going to come up with an answer of minus 4,000. Right, 2.4, use a graph of total cost and total revenue to explain profit maximization in a perfect market. And this is a question which sometimes throw people because they've forgotten about total cost and total revenue curves, right? Your total revenue curve looks like that. Total cost, your total revenue can also go with a bow, right, where it comes down again, okay? And obviously, any points between A and B, this whole section here represents your profit area. But we want to know where is the maximum profit being made or the most profit being made. And obviously, it is at that point where the bow is at its widest. So it will be at 4 units and at 40 Rand per unit. Last question. How effective is the competition policy in regulating mergers and takeovers in South Africa? Right, so I touched on this a little bit earlier on, but we have to look at where have they been effective, okay? There are areas where they have been effective. Remember, I spoke to you about the fact that the bread company, the construction companies, they were all fined. But there are areas where they have been effective in that when Walmart, must have been about 7 or 8 years ago, came in and they wanted to take over Massmart. So for those of you who don't know what Massmart is, that's Dion Wired, Builders Warehouse, Macro, game stores, all of them fall under Massmart. And Walmart has come in and taken them over. But it wasn't just, oh, they come in and they buy it. There were certain rules laid down by the Competition Commission to Walmart where they said you can take them over, but for the first 10 years, they're not allowed to change the staffing. They're not allowed to bring in their own suppliers. They have to buy from local suppliers. And it's going to be very interesting to see what's going to happen now that we're coming to the end of that 10-year period. So the competition policy is effective in that taking into account the public interest effects such as its impact on employment, considering the ability of small businesses owed by disadvantage to become competitive, and in the example there, the merger of Massmart and Walmart, where they ensured that no job losses will occur for a certain period of time, and providing services to local businesses to ensure sustainability of local producers. So they are looking after ensuring that mergers are not for the sake of creating market power and looking into the details of each case and come to a suitable decision. They declined the merger in 2018 where Airlink wanted to acquire Safair, and this was to limit competition due to a few firms in that market, right? But they also approved a merger, once again, with conditions between Regent and Hollard Insurance Companies in 2017. The condition was that no employees may be retrenched for a period of 3 years after that merger. Okay. Right. Grade 12s, I hope you've got a better understanding with regards to perfect markets after the session today. Thank you very much.